Folks, this one indicator is screaming red and is a clear sign that we are in a recession now, and it's only going to get worse. You need to understand this so you can prepare now. Hi, welcome to another episode of Wired for Wealth, guiding you to achieve lasting financial freedom and peace of mind. I'm your host, John MacGregor, your antidote to your financial struggles. And if you haven't already done so, you know what to do. Ring that bell below and hit subscribe. You do not want to miss further episodes. All right, so let's dig in. Okay, folks, get ready for a wild ride. We now have an inverted yield curve, which means big changes ahead, so you got to buckle up. And I know, many of you probably just rolled your eyes right now and thought, how boring is this, an inverted yield curve? Well, I'm telling you, if you really want to know what's going on in the economy and sound smart at the next Christmas party, you need to understand this. The yield curve is the difference between the interest rate on a 2-year Treasury note, basically a US government bond, and a 10-year Treasury bond. And now that has turned decisively negative. This means the rate of interest on a short-term bond is higher than the interest rate on a long-term bond, and that is very unusual. See, normally short-term bonds pay less interest than those that have longer maturities. That's a healthy yield curve. So a 1-month Treasury bill down here will pay this, and a 30-year bond will pay this up here. So you're getting paid more for a longer-term bet with your money. Does that make sense? But now, as I said earlier, it's reversed. That's what's called an inverted yield curve. And many experts will tell you that this is a strong predictor of a coming recession and demonstrates severe investor risk aversion. And today, as I said earlier, the yield curve now stands at negative 0.8%, inverted. And that may not sound like it's too scary, but that is the most negative it's been since 1982. This is a big tsunami coming our way, making things even worse than they are today, which is why I've been saying that 2023, sadly, it's going to be a rough ride. But as I always say, you can make money in any market environment. But here's the deal. An inverted yield curve has accurately predicted the 10 most recent recessions. So you're probably wondering, why is this happening? Well, people are selling their short-term bonds, which makes short-term interest rates go up. Let me explain. If you recall from previous episodes, I've discussed the inverse relationship between interest rates and bond prices, right? So again, when people are selling their short-term bonds, essentially dumping them, the bond prices on those bonds go down and the interest rates go up. Conversely, people are plowing their money into long-term bonds. And when people are buying those long-term bonds, that sends those long-term bond prices up because there's more demand for them. And hence, the interest rates on those long-term bonds goes down. Again, that's the inverse relationship. When bond prices go down, interest rates go up. And conversely, when interest rates are coming down, bond prices go up. Does that make sense? So today, people again are dumping short-term bonds and they're buying those long-term bonds. And my take on this is that people are now believing that inflation is coming down, and therefore overall interest rates will come down as well. So they want to lock their money in for a longer period of time at those higher bond prices because they believe interest rates are coming down. Now, some are saying that because of this inverse relationship, some are saying that inflation is over and interest rates are coming down and no need to worry about a recession. That, my friends, is total nonsense. There's just too many negative things in today's economy. And I think right now, we're having a little bit of a Santa Claus rally right now, duping people into thinking that the stock market is back and up, and away it'll go. No way. Remember when our so-called experts, particularly the Treasury Secretary, Janet Yellen, who in my opinion isn't qualified to manage a Starbucks, when she said in 2021, inflation is temporary? Remember when she said that? It's the most insane thing I've ever heard. And a year later, it was still near a 4-decade high. You heard me on this channel warning everyone that inflation is not and will not be temporary. Sorry, that's just this little self-adulation, right? Look, inflation is not going anywhere. Of the $5 trillion that Biden printed, A huge chunk of that hasn't even been spent yet. And when it does, it's going to maintain or even raise inflation even more. I believe we'll see in the first quarter of 2023 declining GDP growth, if not negative growth. The stock market will test new lows. I mean, I could see the S&P 500 index, which is a basket of the 500 largest stocks in the US. I could see that index testing its low of 3,500. And today it sits at 4,070. We're seeing a ton of companies announce layoffs. I mean, we're talking thousands of people without a job and no income. And that's one reason I believe we'll see slow sales for Christmas. I mean, credit card debt is already at a 15-year high. People have a much harder time making payments now that interest rates are significantly higher. And not to mention, savings rates are way down as well. As a result of all this, corporate profits or earnings are going to suffer. I mean, they actually already are. Corporate profits are up just 2% from a year ago. And corporate profits are the key driver. It's the mother's milk of stock prices. So if earnings decline, so will the stock market. So ignore the news that everything is rosy, because it's far from that. And watch for the Federal Reserve Chairman to pivot, as I've already told you about a month ago on this channel, to lower rates, not because inflation is tamed and the fears of recession are over, but he'll pivot because of the recession. And he'll want to juice the economy and prop up assets artificially again. I'll tell you, he has really screwed all of us and painting us all into a major economic collapse of a corner. It's time to really watch your spending, keep a close eye on your portfolio, and figure out a way to generate cash flow on the side. I'm doing what I've always been doing, which is multiple lines of income streams, and I use a very simple option strategy to consistently generate cash flow. And you can do the same. So I'll wrap there. Just stay focused on your goal, which is living life on your own terms and not on somebody else's. So let me know what you think below. What are you doing to protect yourself in the event of this recession? What do you see out there? What's your forecast for next year? Let me know in the comments. Would love to hear from you. All right, until next time, upward and onward. Take care. Bye-bye.